Welcome to the first episode of Quest for Twice in the new year. I'm excited to start the investment journey in the year of 2022. So first, I just want to document my portfolio position. As of January 4th, 2022, 20% of my portfolio is in my growth portfolio, and the rest of my portfolio positions are about the same as what I outlined at the end of 2021. So the newcomer to my portfolio is Upstart. Right now, it's 5% of my growth portfolio. Today, I'm going to do a deep dive on this company. So, who is Upstart, and how does Upstart make money? Upstart is a AI lending platform. So as a platform, it connects consumers, the borrowers, to AI-enabled banks. So it relies heavily on artificial intelligence to assess the credit risks of the borrowers. Because of it's algorithm-driven, so 67% of the loans are usually instantly approved and are fully automated. 92% of its revenue comes from fees. Therefore, Upstart has no credit exposure. Compared to conventional approach, Upstart looks at a lot more variables to determine the borrower's credit risk. For example, it looks at the employment history, education status, and how the borrowers apply the loans, and etc. And the conventional approach usually focus on the FICO score, then with very few other variables. But Upstart looks at more than 1,000 variables. So this company reminds me of Google. So it's a potential Google in lending because it uses algorithms to provide a superior product and to better predict the default risks of the borrowers comparing to the status quo approach. So 86% of its 2020 revenue came from platform and referral fees. And that equates about 6% of a take rate from transactions happened on its platform. The rest of the fees come from the loan servicing. Upstart experienced explosive revenue growth in the last 5 years, as shown in the graph at the bottom left. Its 5-year revenue CAGR is about 85%, just an astounding amount. And if we look at the numbers closely, the revenue in 2020 is below trend. It's because of initially during the pandemic, the banks cut back on the amount of lending. And later on, the government, through the fiscal stimulus, gave a lot of money to a lot of people and reduced the demand for personal loans. And 2021 is above trend, likely due to a catching up and more borrowers emerged after they spent their government stimulus money. But the management attributed the 2021 revenue mostly to the model and the algorithm upgrades, and less to the increased demand. Because of the revenue in the year 2021 was overwhelming compared to previous years, so it helps to look at the revenue in the last 8 quarters. Under each quarter, there is a year-on-year quarterly revenue growth. So we can see that for Q4 2019, before pandemic, the revenue growth was 162% year-on-year. And in Q1 2020, the revenue growth was more than 200%. So those were really explosive growth that one may not realize if only look at the annual revenue in the bottom left graph. Of course, the Q2 and Q3 revenues were depressed for the reasons I mentioned. And now in the 3 quarters in 2021, the revenue grow significantly. So in the Q3 2021 alone, the revenue in that quarter was more than the annual revenue in the previous years. So with the recent phenomenal growth, can Upstart continue its very fast growth in the future? So what are the growth opportunities? So for the short term, Upstart can have a better marketing to reach potential customers. For example, it recently started a Spanish version of its website to better reach the Spanish-speaking borrowers. And it has continued to grow its bank customers to 31 banks comparing to 10 1 year ago. So the new bank partners will also bring in new potential borrowers. For the same amount of applicants, it has an opportunity to have a better conversion them to borrowers, to have a higher approve rates. So in the Q3 2021, its conversion rate was 23%, and comparing to 15% 1 year ago. Up to today, it focuses on personal loans, but it has already started making auto loans, and it also plans to make small balance loans and small business loans. Those are all growth opportunities in the next 1 to 3 years. In the long term, we can look at the total addressable market. So the personal loan market is about 81 billion and is making great stride in taking market share. The auto loan market is much larger. Upstart has started to make inroad in the market, although its current revenue has not really benefited from auto loans. And in the long term, it plans to move into mortgage loans, and that's a huge market. So if Upstart can take 50% of a market share in all those markets, then we can calculate its annual revenue in that scenario. So for personal loan, 5% of 50% of 81 billion is 2 billion. And the auto loan, because the loan amount is higher, so assume 2.5% of take rate and get us to 8 billion revenue. And for mortgage loan, 1% of that market take rate is about 22 billion. So the mortgage market opportunity is huge, even the take rate is only 1%. So add those together, that's a $32 billion revenue. Of course, if its market share is less, for example, at 25%, the revenue will be half of 32 billion at 16 billion, which is still a very, very large number. And interestingly, if we ignore the mortgage market and at 50% of auto loan and personal loan market, then its revenue can reach $10 billion. So does Upstart have any moat? So network effect of borrowers and lenders are not there yet. Banks are very conservative and slow to adopt new technology, but it's making inroad and currently has 31 bank customers compared to 10 1 year ago. So once more banks get on board, eventually there will be network effect. Switching cost. I think there is a possible switching cost. If Upstart can price credit risk more accurately, i.e. provide a very good quality product with highly automated loans. So that's fast and cheap to approve loans. So as a result, its bank customers will be hooked, so to speak, by its product and will suffer if they switch away from Upstart. Intangible asset. That's also a possibility in terms of a moat that's in Upstart's AI model. It currently has 17 million repayment events and 28 billion sales of training data for its AI model. So it'll be hard for a newcomer to catch up with its existing AI model. I don't believe there is any brand value yet, as most people would not have heard of Upstart. A quantitative way to measure moat is to look at the return on invested capital. So Upstart has 25 to 35% of ROIC before tax, despite the pandemic. My estimated 2021 ROIC will be over 50% based on the company's guidance. So those are very, very high number, indicative of a wide moat. So can competitors come in and make a good AI model to take away Upstart's business? I don't believe that will be the case from banks, because small banks are Upstart's customers. So they don't have the economy of scale to build a good AI model. A big bank, in theory, can develop its own AI model, but it will be unlikely to help its competitors by giving them access to its model. I do believe the legacy credit bureaus, for example, Equifax, could be competitors, as they have data already. Their current business model is to sell data, for example, the credit history as well as employment verification. But they don't underwrite the loans. Compared to Upstart, approves loans instantly while also weeding out the frauds. So Upstart does more than just give data. It actually underwrites loans. So can the legacy credit bureaus change and innovate? I think that's a possibility. Equifax has 380 million employment records, and Experian has repayment data on 1.2 billion people and 145 million businesses. So they definitely have a lot more data than Upstart. And if they can innovate and develop an AI model, then they could become worthy competitors. So what are the threats and the opportunities? The Upstart's edge is its AI model, which is hard for me to assess. Actually, I believe it's hard for analysts to assess also. It has not been tested in all conditions. For example, a borrower may default an AI loan first before a conventional loan during economic distress. That's likely because, as I mentioned earlier, the AI loans are approved instantaneously and no human touch. So the borrowers may think of those loans in a less personal way. As I mentioned earlier, Upstart had a rapid growth because the legacy credit bureaus had an inferior product. They did not accurately assess the credit risk of subprime borrowers. If they also develop good AI models, they may become strong competitors. Another threat is a high percentage of increase in the past came from credit karma. So this is a high concentration risk. So can Upstart diversify into other marketing channels? On the other hand, if Upstart is truly provide a good product, then Credit Karma will not be in a strong position to drop Upstart from its offering. Otherwise, its offering will become less competitive. Speaking of market share, the credit risks of prime borrowers may have been properly assessed already. Therefore, it will be hard for Upstart to disrupt there and provide a valuable product, especially related to mortgage. And that's because of a mortgage are usually backed by government-sponsored enterprises like Fannie Mae and Freddie Mac. So the implication is that Upstart the market share in the total addressable market may not be as high as I previously estimated. At this point, I don't think anyone knows. Lastly, the consumer lending is highly regulated and very complex. So Upstart may run into regulatory troubles because it's a disruptor and the rules may not be well understood related to how to apply to Upstart's approaches. So what's interesting is that all the items I listed here are threats. So the conclusion is that there is a high degree of risk to Upstart business and to the future growth. Then the logical question is why bother with such a high risk investment? The answer is Upstart has potential to become a very successful company. So let's look at its valuations. So the chart on the right shows Upstart stock price movement in last year in terms of percentage. So it actually was one of the meme stocks. At its peak, it had 800% return. Also had a wild swing from 200% return in August to shoot up to 800% return, then drop back down to 200% return for the year. So it's extremely volatile. At the current price, about $140 per share, its price over sales is about 14, using the estimated 2021 revenue of $800 million. For comparison, Equifax and TransUnion has a price over sales ratio of 7.5. So Upstart is more richly valued because of its high growth. What's interesting is comparing the price over sales ratio to the end of 2020, 13.6. So it barely changed, despite the 200% stock price increase. That's because of the very strong revenue growth I mentioned earlier. So the stock price increase was solely driven by the business performance at this point, despite the wild price swing in the Q3 and Q4 of last year. So with a CAGR of 85%, its duration to parity is 4 years. That's not that long. So I believe the downside risk is limited as long as the company can continue its fast growth. What's interesting is to look at the upside. The future market cap may reach 100 billion if sales can truly reach 16 billion as I calculated on the back of an envelope. It's just using a price over sales ratio of 6. So its current market cap is 11 billion. So it has a potential to have a 1,000% return at this point. That's what I meant when I said it has a potential to have a huge upside. The success of this investment is really depending on its future revenue growth. As long as the revenue growth will be there, its downside risk is very small, in my opinion. However, as I mentioned previously, there are a lot of threats to its business. I consider this as a high-risk investment, so I will limit my portfolio size in this company. So this wraps up the deep dive in Upstart. Until next time, happy investing.